Hello, myself Ankita, faculty at Commerce Department, Hansraj College, University of Delhi. So we will start today with the introduction of the financial markets. In this video, we will learn about what do we mean by the financial markets, what is the role played by financial markets in the lives of households, businesses, as well as in the economy, and what are the different types of the financial markets we have. So let's start with our video. First thing first is the introduction of the financial markets. Whenever we hear the term the market is a platform where two parties meet. One is the seller, other is the buyer. Seller wishes to sell its goods to the buyer in exchange for the money. Same happens in the financial markets, but here the products are different. So in the case of financial markets are any marketplaces where securities are traded, and securities such as stocks, bonds, foreign exchange, money are traded, right? And the trading of securities happens through the regulated or listed stock exchanges or through the over the counter markets. So the listed stock exchanges are the two major stock exchanges in India are National Stock Exchange and the Bombay Stock Exchange. They have their particular physical space and they comes under the regulations of the Securities and Exchange Board of India. Another we have is the over-the-counter markets. Over-the-counter markets are the markets which do not have any physical existence, and the trading happens telephonically over the country. So the financial markets trade in all type of securities and they plays a very important role in the smooth operations of an economy. If financial system fails, it leads to economic disruptions like unemployment, inflation. Like we have seen various financial crises happened in different countries like USA, various Asian countries, where the whole economy got disrupted, got disturbed due to fail in the financial markets. Next, what is the role played by the financial markets? So in the case of financial markets, we have two parties. The first party we have is the deficit units. What is deficit units? Deficit units are the units whose expenditure is more than what they earn. So in order to meet their expenses, they have to raise funds or borrow funds from the market, from the financial markets. So deficit units are usually the corporation who wishes to expand their operations, expand their units in different cities or countries. Then there are startups who want to start their businesses and who needs funding in order to establish themselves in the markets. Then there is a government who require funds for various investments, like investing in infrastructure, in making roads, in building parks, etc. So these are the units which require funds in order to meet their expenditure, and they borrow their funds from the financial markets. Then we have the another units, which is the surplus units. So the surplus units are those who earns more than what they spend. So they have net savings available with them, and they park their net savings through investing in different securities through the financial markets. And who are the surplus units? Surplus units are usually households as well as the investors. So what happens? What is the mechanism? So what happens that deficit units issue securities like stock, bonds, debentures to the surplus units. Surplus units bought these securities and in return provides funds to the deficit unit. So this mechanism happens with the help of the financial markets. So we can infer that the financial markets helps in accommodating the corporate finance needs for the deficit units. So their corporate financial needs, whatever needs they have related to financing, these needs are accommodated by the financial markets. Also, it helps surplus units in accommodating their investment needs. A financial market suggests or advises surplus units that in which securities should they invest, at what time should they invest so that they can earn the maximum returns. and it creates liquidity for the securities. Liquidity means that assets can be easily convertible into cash. Like, if I hold some securities of, let's say, Tata Motors, and I wishes to sell that securities in the market, I can easily sell out through the secondary market. So that's how liquidity is created, that I can easily convert that securities into cash by selling it out. And it leads to capital formation for whom? For the companies. Like, companies wishes to expand their capital, they want to raise new shares in the markets, they can do it through the primary market by releasing an IPO, which is initial public offer. So financial markets also helps in the capital formation for the companies. After understanding the role of the financial markets and their basic introduction, there are various types of financial markets which exist. The first one is the primary market, in which new issuance of securities happens, that the new securities can be issued through the primary market. Then we have is the secondary market. In the secondary market, already listed or already trading securities can be brought and can be sold in the secondary markets. Other markets are money market, capital market, over the counter market, foreign exchange markets, derivatives markets, commodities markets, and the newly established cryptocurrency markets. We will discuss about each market in detail in our upcoming video. So, in order to learn more about the financial markets and to enlarge their vision about the finance, stay tuned for the upcoming videos. Thank you.